In the name of Allah, the most beneficent, the most merciful. I am Muhammad Asif Chaudhary, and today I read an article. The article was very beautifully elaborate the tax avoidance. As you know, I am the student of tax avoidance. I write on tax avoidance, I read tax avoidance, and I tell you about tax avoidance, what are the benefits of tax avoidance and what are the problems of tax avoidance. Therefore, I read an article written by Kyo, and it was published in Journal of Business Research. Journal of Business Research is one of the best journal regarding the business publications. Therefore, the topic was your heart is where your treasure is. Where is your treasure? There is your heart. And the family chairman and tax avoidance in family control firm, and what is about the if the chairman is a family member, and what are the will be the result of tax avoidance in that firms. Now I will explain that research. It appeals to me a lot, and Mr. Keo et al. In 2023 write a very good article in Journal of the Business Research. What is the motivation and background in this result was that the family firms are dominated organizational for the worldwide in China, because there are a lot of family firms like in Pakistan, you know, most of the big firms are family controlled firms. Like that, in all over the world there are most of the family controlled firm. Like that, in China there is the most of the firms are family controlled, and tax avoidance is a double-edged sword. Why it is double-edged sword? One time it is the cash value and gain, versus it damage the reputation and political cost. On one side it gives you a gain and cash rewards and cash flows and value of the funds, and on other side it damage your reputation and you have to bear the political cost and media cost, etc. all are in this research. And most tax avoidance studies use agency theory, but in this reputational and socio-economic aspects are underexplored. But this study is relating to socio-economic wealth, and because the family member is a chairman and he promotes the socio-economic on the wealth. He did not accept the wealth on his bad reputation or on the stake of goodwill. This is the background of study, and research on which the research focus on how does having a family members as a board chairman affect the corporate tax avoidance in a family controlled firm. Mean when there are the family controlled firm and chairman is from family member, so what is the effect on tax avoidance? Is he avoid more taxes or less taxes? And do family chairmen behave differently from non-family chairmen in balancing the economic versus non-economic goal? And what is the behavior of the chairman which is from family? Is it like a non-family or on other ways regarding the economic and non-economic goals? And is the chairman more important than CEO, CFO in exploring the tax avoidance in Chinese family firm? Or CEO or CFO can avoid the taxes in presence of family controlled chairman, or they act like the behaviors of chairman of the board, and how he can advise them to avoid or not to avoid the taxes. This is the focus of research. And the key concept, as per key concept of the research, there is the family firms. One mean family firms who have a more of the stake regarding a single family, and ultimately owners natural person or a family with more than 10% of the shareholding robust to other threshold. Mean he has a more than 10% shares to the specific family, and family chairman, the board chair is member of the controlled family, founder or close relatives. He may be a founder of that firms, or he may be a close relative of the founder, and he will control the firm. Board will be chaired by the family member. And tax avoidance, legal reduction of tax burden. One thing is that tax avoidance is a legal. It can be avoid taxes in the parameters of the legal ways. Whichever firms avoid the taxes, they take the loopholes of the law enforcement agencies and authorities, and from that loopholes they avoided the taxes, versus accounting and tax planning strategies are used for tax avoidance or not. And the socio-economic wealth, SEW, socio-economic wealth, whenever we use that SEW abbreviation, that theory deals with the how the family controlled firms chairman can prefer on avoidance of taxes on wealth to his stake or reputation is that. It is the main concern that we always use agency theory in research regarding the tax avoidance. Now, socio-economic wealth, non-financial benefit that satisfy the family's social and affiliative needs, identity, control, legacy and altruism. Is the wealth necessary, or the legacy of the family is necessary? Social economic will give the difference between the wealth and goodwill. Family leaders are willing to sacrifice financial gains to protect SEW and the family reputation. Then when the family controlled firm, the chairman of the family will prefer his reputation on the wealth. That is the socio-economic wealth theory. And SEW is used as a reference point, and perceived threaten leads to the risk-averse reputational protecting choice. Whenever you avoid the taxes, you will lose your reputation, your goodwill, and it will gain you a wealth, but your reputation will be lost. So the socio-economic wealth theory protect it, that your social and status, your legacy, your goodwill is preferred to the wealth state. That is the socio-economic theory. And tax avoidance as a double-edged sword, as I explained already, that on one side the economic benefit, higher tax profit and more internal funds, lower financing cost and higher firm value. Tax avoidance increase the cash flow. You can gain more by reducing the tax expense. That is the one way of the sword. And the other way is non-economic cost, increase the scrutiny and penalties. Then the scrutiny and penalties will increase. The agency will check your books of account that you are avoiding taxes, and whenever you come in the lens of the authorities, then always they will check you, and you will have to face the penalties. If you face the penalties, then your reputation will go bad in against your customers, and customers will, you will lose your loyalty from your customers, because they will not prefer on your reputation. They will not be loyal with you, because you are avoiding the taxes. And the political cost, damage of reputation and customer trust, all will be gone by avoiding the taxes. And in socio-economic wealth theory framework, family leaders may avoid aggressive taxes. They did not aggressively avoid the taxes, and tax planning go to protect long-term reputation. They plan their taxes to protect their reputation for a long term, and they did not lose their reputation against the wealth. Then the institutional context Chinese family firm, what are the institutional contexts of the family Chinese firm? That over 85% of private firms are family firms, 67% of the listed firms are family control. Because this research regarding China, and in China there are 85% of the private firms are the family firms, and because we are taking the sample of listed firms, in listed firms 67 of the listed firms are family controlled in China, and most are young and relative to small, typically led to the first and second generation enterprises, because the China was not capitalized first. Therefore, they from 1970s they are going to the privatization, and the first and second generation now taking the privatization of their firms. And confiscation based clean culture and unity of network make the family and firms reputational particularly silent. So they have to because they have their circles regarding the businesses, and it is their interlock circle in China for running a business. In China, the chairman usually hold the more decision power than the CEO, especially in family firms. In family firms, most of the decisions are done by or taken by the chairman, then CEO or CFO. So that is the institutional concept or Chinese family firms. What is about the institutional context? Tax avoidance in China. While the separation of tax laws and accounting standard plus tax incentives create a scope for tax avoidance, because the accounting standards are separate regarding accounting, and the tax accounting is different in all over the world. It is the phenomena that two accountings are separate books for both the accounting. So it creates the problems that the taxpayer or firms avoid their taxes, and aggressive tax avoidance is considered unethical and can result in the severe legal and reputational sanctions. When the organizations aggressively avoid the taxes, then they have to bear the unethical results and serve the legal and reputational sanctions. They have to observe the sanctions and penalties, and high profile enforcement cases and the public zero tolerance policies increases the reputational risk of the tax planning. When the reputation on stakes, the agencies observe keenly the books of account and sanctions and audit of that firms. Therefore, they cannot tolerate on their reputations and increase the sanctions on that firms. And when there is a family chairman is well-known firm, often highlighted the social responsibility and pay relatively high effective tax rate. Then the tax, when who person pay the more taxes, that organization which is a family control, and they have to sake of their goodwill and their family reputation, they pay high taxes. When they pay high taxes, it means they did not avoid the taxes. What is the hypothesis? Because this research is done in China, and they selected what hypothesis: the family chairmen are strongly identified with the business and family reputation, because they have a say for their reputation should be good, they should not be dissolved or stolen. So they place greater weight on socio-economic wealth theory and long-term reputation than the short-term tax saving. They prefer the long-term reputation against the short-term tax savings, because when you save a tax is short-term, it will reduce your reputation for a long-term. Therefore, the family control board or chairman did not prefer the taxes. So we designed the hypothesis 1, that family firm with the family chairman engage in less tax avoidance than those with the non-family chairman. Mean, first hypothesis is that the family chairman or family controlled chairman avoid less taxes than the non-family chairman. And hypothesis second is the reputational risk as a moderator. So reputation is the main concerns for the family control firms. So the reputational risk is the higher for firms with greater public visibility and tighter family firms linkage. The families which have the good linkage of family firms and they have a public interest, they have a higher risk for reputation. And proxies of this, the firm age, older firms have a more established reputation, because when the firms are older, they have a good and old reputation. Like most of the firms claim that we are working since from and we are working from centuries or years. So they have more concern than regarding their reputation. And the direct ownership by the family. Then the second hypothesis will be designed that the negative effect of family chairman on tax avoidance is stronger in firm with the higher reputation risk, mean which has a more reputation risk, they are strong, they avoid less taxes, they did not go to the avoidance of taxes. Which the author used the data and sample from the population of Chinese, a share of listed controlled firm from 2007 to 2016, and the exclusion financial firm, negative pre-tax income and negative tax expenses, miss nominal tax rate and negative market to book rotations and incomplete financial data. They take only the non-financial firm, because financial firms are mostly the service provided firms, and the major contribution to the employment, major contribution to the production GTB is from the non-financial firm. Therefore they selected the non-financial firm, and they exclude from his sample all the negative who have the negative tax, and the firms which have the normal tax rate or which are in loss, all are excluded. Final sample of 1855 family firms and 8743 financial year observation were creating, mean total firm are 1855 and data is from 2007 to 16. So 800 observation for the firm years are observed for analysis, and analysis was run on that firms. And what are the key variables in dependent variable is the tax avoidance, because they have to measure the tax avoidance, and TRD nominal tax rate, mean current plus deferred tax expenses, included all the tax expenses, the current plus deferred tax expenses divided by pre-tax income, and the Desai and Dharampala's book tax difference, adjustment book tax difference pronged by accrual Desai and Dharampala 2006. This proxy is mostly used by the Desai and Dharampala, and main independent variable are the family control is dummy 1 if the chairman is from family, and 0 otherwise. Mean if the chairman is from family, then the proxy will be taken 1, but if the chairman is not from family, then the proxy will be taken as 0. That is taken by the author, and there are the control variable, because all the analyses are run by a control. Which are the control variable? That are the firm characteristics, mean size, leverage, return on asset, book to market value are taken as a control variable, and asset structure, plant, property and equipment, intensity, inventory ratios, intangible assets and assets are also taking asset turnover as taking as a control variable, and governance, large shareholder stakes and institutional shareholdings and board independence, CEO, chairman, duality, all are taken as a control variables. Year and industry fixed effect, including the standard error and clustered at the firm level, are taken as a control variables. What was the model? For all you know, as being a researcher, that when we run a regression, there we developed a regression model, baseline of orderly least square specification OLS is the tax avoidance alpha 1 family control plus sum of all the control variable and years and industries are taken as a control variable. Then we run the this model and we take the result of family. Key parameters of interest alpha is 1 is less than 0 would be supportive, and H1 family chairman is less tax avoidance, mean when family there is will be a family chairman, tax avoidance is less. It is the result of the research. As I studied I did not include it table in my presentation, but all the research was significant, and significant research shows that the family chairman avoid less taxes. Main empirical results was that the research shows that family control has a significant negative coefficient in both tax avoidance models, both the regression models that are used for the proxies of tax avoidance, and that is TRD and DD book tax difference regression model are both significant, and the magnitude family chairman are associated with 5 to 6% reduction in tax avoidance measures. Means this is the result that when there is the family, there is the controller or chairman of the organization is family member, he can reduce tax avoidance 5 to 6%. Means that is the major portion of the tax avoidance that is reduced due to the chairman. It means it avoid low taxes. And interpretation of the family-led board appears less willing to exploit tax avoidance opportunities, then board is also less exploit the tax avoidance opportunities when there is the control by the family chairman. Moderating role of reputational risk, because when you avoid the taxes you lose your reputation. So what is the effect of Sankara hypothesis? The firm age interruption family control multiplied by family age is negative. The effect of the family chairman is stronger and older firm, and the ownership structure interaction family control multiplied by direct ownership is the negative effect stronger when the family direct owns the listed firm's reputation is more tightly linked with the family. When there is a family firm, they more concerned about the reputation, and they did not avoid the taxes to increase their reputation. Like that, the finding supports H2 that the reputation risk enhance the socio-economic wealth theory driven by the conservatism in the tax decision, mean they prefer to the reputation than the tax avoidance. And if the family CEO, CFO versus family chairman, when there is the family chairman, I think family chairman controlled more as per this research. Family CEO or family CFO individually shows the negative association with tax avoidance, because when they are family members they also avoid the taxes, and when family control chairman added the effort of the family CFO and CEO become insignificant, including when there is a chairman included, so they become insignificant. Firstly they are significant, but when there is a chairman then there is insignificant. So include family control, family CEO and family CFO together, only family control remain significant. Conclusion, family chairman have a dominant influence over the tax avoidance decision, because when there is a family chairman then CEO and CFO cannot be significant, and when there is not family chairman then they are significant. So family chairman is a more significant and dominant on the CEO and CFO. And chairman turnover analysis, if we do the turnover analysis, if the chairman change during the period and it change from family to non-family or from non-family to family, then what effect comes on the results? That even study on the firms with the single chairman changes during the sample period non-family to family. When they change from non-family to family, the chairman tax avoiding significantly decreases after the change. When from non-family to family, tax avoidance decreases. But when family to non-family chairman decrease, the tax avoidance significantly increases after the change. It's mean when the family controlled organization, then chairman is family, then tax avoidance is low, and when there is non-family, then tax avoidance will be high. So supporters as a casual interpretation, leadership identity matter for the tax behavior, it's the result. And when we ruling out agency theory explanation, because we are always use the agency theory for taxation matter, but in this study they use the socio-economic wealth theory. So what are the effect of overruling the agency theory? That test is the alternative driven consistent with the agency theory. Alternative use key use the theory, that is the tunneling of incentives, control cash flow right, webbing and recoverable, managerial self-interest, admin expenses and executive perks etc. are used. Weak internal control, IC attendant and internal control deficits, so that interaction with family control generally insignificant agency based channels cannot fully explain the results. So socio-economic wealth theory and the reputational concept provide the better fit for evidence. So socio-economic wealth theory is most beneficial when there is a family control chairman than the agency theory. So it overcomes the rulings to the agency theory. Robustness checked by that the instrumental variable approaches using the regional divorce rate to instrument for the family chairman. As we are the research use that if there is a chairman from family, what is the ties between the family, what is the relation is strength of the relation between the family. They check this relation by the divorce rate of the region. If divorce rate of the region is more, then there is no ties between the family or weak ties. When there is a divorce rate is low, then there is a strong tie between the family. That is checked from the divorce rate of the region. And prosperity score matching PSM based on the firms and the governance characteristics, and alternative tax avoidance measures TDR, no deferred taxes and book tax difference are used, and the results consistently shows that negative impact of the family chairman on the tax avoidance. All the results shows that the family chairman reduce the avoidance of taxes. That is the significant. And what is the contribution? This research has a good contribution in the extending socio-economic wealth theories literature by identifying the tax avoidance as an important financial decision shaped by the socio-economic wealth theory shaped the tax avoidance when there is a chairman from the family, and shift focus on CEO and chairman, showing the board chairs central role of the family firm's governance. CEO has a main chair of the board is main is this aspects, and add the non-agency reputational based perspective to the corporate tax avoidance literature is also because first of all mostly the agency theory was used. Now the socio-economic wealth theory is also used, and non-agency theory can be used. Managing and policy implementation, what are the policy makers can do on the base of this research. It is decided that the board seeking to reduce aggressive tax avoidance may benefit from the leaders who internalize the long term, because for a short term it is not beneficial, but for the long term who did not avoid the taxes, they firms stay for a long period and their sustainability increases. And the reputational concerns, example family chairman are the reputational sensitive, non-family chairman. Family chairman is more sensitive for their reputation, and they try to increase their reputation regarding the firm. So tax authorities should consider governance structure when assessing the firm's tax risk profiles. When there is a risk profile for the organization, tax authorities should be vigilant on that authorities, and they increase their check, sanctions, penalties, etc. for the risk profiles. And investors can interpret family chairmanship as a more conservative tax behaviors in China. They also the investors try their best. They choose who is the sustainable firm and who will take the taxes more or less. And not the limitation of the research, because every research has some limitations. And what is the future research? The limitation is that data is limited listed Chinese company, because the data is only limited to listed Chinese family firm. Result may not be generalized for the unlisted firms. And second one is focus on chairman, CEO and CFO. Other top executives and board committees remain unexplored. Only mostly focus was on the chairman, CEO and CFO. The other may be dropped down and is unexplored or unchecked. Future work could study the direct economic consequences of socio-economic wealth theory, losses and long-term outcome of tax choices, and compare the governance and tax avoidance linkage across the institutional environment. Mean in future the socio-economic wealth theory can be used for the tax behavior, tax decisions, etc. for this thing. And thank you very much for question and answer, because you are not available here, so I give my number. If you have any problem, any concern regarding this research and my presentation, you can call me a lot, or you can comment in the comment box, and you can ask any question if you have in your mind regarding the research of tax avoidance. And I think you will understand all the things, all the concept of this research. And if you have any problem, you can comment in comment box. And if you understand it, for the understanding of other people's, like, share and subscribe. Thank you very much. Have a nice day.